Well, good evening, everybody. We're going to go ahead and get started with tonight's session. We don't have any attendees, but hopefully some will arrive and be here to go through the problems of Chapter 10. I am going through all the practice problems that are in Chapter 10 as usual. And so we're going to go ahead and get started. Next week, I will be postponing the study session to Monday night since Easter Sunday is next Sunday, and I will be posting an announcement to that effect as well. So in question number 1, identify the following as either an advantage or disadvantage of bond financing for a company. The first one, bonds do not affect owner control. That's an advantage because that way you can raise money without giving up ownership in the company. And with ownership comes control. Next, a company earns a lower rate of return with borrowed funds than it pays in interest. That's a disadvantage. And the reason why it is a disadvantage, because you're paying interest, okay? And, you may or may not get the rate of return to even cover your interest. And if you don't, you're headed for trouble. The company earns a higher return with borrowed funds than it pays in interest. Definitely an advantage. A lot of companies will do a careful analysis before they go invest in projects. And one of the things they make sure of is that they have to borrow money through bonds, that the return on their project is going to be greater than what their market interest rate is, or stated interest rate too. Bonds require payment of periodic interest. That's a disadvantage because if you don't have the money, you've defaulted on your bonds. Interest on bonds is tax deductible. Definitely an advantage. Anytime that you can create tax deductions, that definitely works in your favor. And then finally, bonds require payment of par value at maturity. As you're going to see, we're going to be issuing as much as $100,000 in bonds, and you got to come up with that money when the bonds are due. Again, if you don't have it, you default, so that's a disadvantage. Question number 2, Madrid Company plans to issue 8% bonds with a par value of $4 million. They'll sell $3.6 million on January 1st and the remaining $400,000 on July 1st. They're going to pay semi-annual interest on June 30th and December 31st. So we're going to record the entry for the first interest payment in June. Now, what you need to know about this is we're going to multiply the 8% times the $3.6 million because that's all we have outstanding. That's all we have to pay. And what that's going to, we have to then take that and divide it by 2, okay? Because we're making 2 payments through the year. It's still 8%, so we're going to pay 4% now and 4% later when we have semi-annual interest, okay? If it was quarterly payments, we'd be paying 2% of the amount of the issue, all right? So to record the first payment, I'll just give this to you. You're going to do a debit to bond interest expense for $144,000, and you'll do a credit to cash for $144,000. The next one, we have to record the issuance. Now, to record the issuance, what you're going to do is you're going to do a debit to cash for $400,000 on July 1st. Where is my cash? Here we go. All right. And then we're going to do a credit to bonds payable. And this will be for $400,000. Okay. Question number 3. On January 1st, Renewable Energy issues bonds that have a $20,000 par value, mature in 8 years, pay 12% interest semi-annually on June 30th and December 31st. What's that tell you? We're going to issue 6% of the par value at those times. And by the way, we're going to start talking about market rates now. The interest is always calculated on par value. Remember that. All right. Even though we're going to be selling these things for less than par value or for more than par value, we still figure the interest on par value. And when they mature, we're going to pay out par value, even though if we paid a lot less for the bonds. So we're going to have to prepare journal entry for the issuance, assuming the bonds are issued at 99 and 103.5, which if you read your books, you know that that's 99% of the par value or 103.5% of the par value, okay? So first we're going to record, oops, I went too far here, hold on. So first we're going to record the issuance of the bonds at 99. So on January 1st, we're going to go ahead and we're going to do a debit to cash. Then we're going to have to do a debit to discount on bonds payable. Let me go over something real quick so you have it straight. Let me find discounts of bonds payable. And then we're going to do a credit to bonds payable. All right, so when you're selling below par value is 100, okay? You're selling below par value, which in this case is 99. That means we're selling at a discount. If we're selling above 100, which is what we're getting ready to do with 103.5, then that's called a premium, which means you're spending more money for the bonds than what they were originally issued at if they were issued at par value, okay? So in this one, we're going to do a debit to cash for $19,800. We're going to do a discount on bonds payable of $200. And then we're going to do a credit to bonds payable of $20,000. If you see that you're selling at a discount, you're going to have two debits. If you see you're selling at a premium, you're going to have one debit and two credits. All right. So keep that in mind. That might help you get through the problem. Okay. For the next one, selling at 103.5, like I said, we're going to have a debit to cash only. All right. And that's going to be at 20,700. How do we get 20,700? We're going to multiply 20,000 times 103.5%. Okay. That's how you get there. All right. Then we're going to have a premium, a credit to premium on bonds payable. And then we're going to have a credit to bonds payable. Okay. Next, Allegiant issues 6% 20-year bonds with a par value of $2 million. And we're going to be doing semi-annual interest payments. In each separate situation, determine whether the bond is issued at par value, at a discount, or a premium. So again, 6% is going to be the issue at par value. If it's issued at 5%, that's going to be issued at a premium. Okay. Market rate is issued at par value. Okay. And if the market rate for the bond is 7%, and this is, keep in mind, this is an inverse relationship. So if the market percentage is higher, all right, it's gonna sell at a discount. If the market rate is lower, it's gonna sell at a premium. That's the way you got to look at it. Okay. Problem number 5. Need to take a sip of water here. Mouth's getting dry. Biro Company issues 8% 10-year bonds with a par value of $250,000 and semi-annual interest payments. On the issue date, the annual market rate for these bonds is 10%. This implies the selling price of 87.5. All right. So first we have to record the issuance of the bonds at par value. All right. Yeah. So the first entry is going to be, oh, wait a minute, wait a minute, I'm reading this wrong. So we're going to have to do it at 87.5%. So we're going to multiply $250,000 times 87.5%. Then we're going to do a debit to cash. We're going to do a debit to discount on bonds payable. And we're going to do a credit to bonds payable. And so I believe that comes to 218,750, 31,250, and finally 250,000. Okay. Next, Garcia Company issues 10% 15-year bonds with a par value of 240,000 and semi-annual interest payments. On the issue date, the annual market rate for these bonds is 8%. So they're selling at a premium. Remember, inverse relationship. That implies a selling price of 117.25. So in this case, we're going to do a debit to cash. And 218,750. Then we're going to do two credits. First one is discount on bonds payable. And it's going to be bonds payable. I'm sorry. I take that back. We're going to be doing one credit. What we're going to be doing here is, well, wait a minute. No, that's right. Hold on a minute. I selected the wrong one. Premium on bonds payable. Sorry about that. Got sidetracked. And then bonds payable is correct. So what we're going to, oh, this is 281. I was looking at the wrong numbers. 281,400. The premium is going to be 41,400. And the bonds payable is going to be 240,000. Now, I want to point out that when this matures and the company has to cough up the money for the bonds, they're only going to cough up the par value, even though it was selling as a premium. Something you have to keep in mind. All right. All right. Enviro Company issues 8% 10-year bonds with a par value of $250,000. Semi-annual interest payments on the issue date. I'm sorry, on the issue date, the annual market rate's 10%. Okay. Which means they're selling at a discount. And that implies a selling price of 87.5. What is going to be the cash proceeds on the issuing of the bonds? 218,750, which is 87.5 times percent rather times 250,000, or you could multiply 250,000 times 0.875. All right, what amount of bond interest will be recognized over the life of these bonds? Semi-annual interest payments means we're going to be making 16 payments. Let's see, 16 payments of $10,000 payment. And that comes to, oh, wait a minute, I got that wrong. Hold on, 10-year bonds. I was thinking 16 for some reason. That's 20 payments of 10,000 for 200,000. The par value at maturity will not change. It's still going to be 250,000. That's what we're going to pay out when the bonds mature. Okay. So if you take the amount that we borrowed, which was 218,750, right? That comes to total bond interest expense will come to $231,250. All right, it's a way of backing into what we, instead of going in the front door, we're kind of going in the back door with this problem. What's the amount of bond interest expense recorded on the first interest payment? Well, that's going to be $11,583. How do we get there? Well, we got there by taking $231,250 from requirement number 2, dividing it by 20, and that gives us 11,005. I put 83. It should be 63. I'm sorry. Okay. All right. Next, SNAP issues 10% 5-year bonds on January 1st of this year. It has a par value of 100,000. So, now, and we're going to have semi-annual interest payments. So on January 1st, we're going to issue the bonds. Okay, and the unamortized discount is going to be $73.60, and the carrying value is going to be $92,640. So that means that we're selling at a discount. That means we're going to have 2 debits and a credit. So our first debit's going to be the cash. Second one's going to be discount on bonds payable. And then we're going to have a credit to bonds payable. And so we can go up here and we can take as a credit, our debit for cash is $92,640. And then our unamortized discount is $73.60 to begin with. And then we're going to be issuing the bonds at $100,000. Now, this really requires a table, because on June 1st, the first payment is going to be going to drop the carrying value down to $93,376, and the discount's going to drop to $66.24. So let me see if I can find a table on this to walk you through. All right, so on June 30th, your discount on bonds payable is going to be $73.60, which is where we started up here at the beginning of the year, minus $66.24, which is the unamortized discount, and that gives us the interest on the bonds in the first payment comes to $736, or really the discount for that payment comes to $736. Okay. And so that is what we're going to have to do, is that's going to be our credit to discount on bonds payable. Because you see, when we make payments, we have to drop down that amortization down so that we're working towards 0 by the time that the bonds are actually paid out. That's what a lot of students have trouble with, is we're kind of like going towards 0. So the bond interest expense for June 30th, let me see if I can, bond interest expense is going to be $57.36. We're going to debit discount on bonds payable $736. And then we're going to be crediting cash $5,000. Now, if you notice something here, so what we're doing is we know what the if we know what the interest is, all right, if we take the interest payment we're required to make, which is $5,000, add it to the discount on bonds payable for this payment, that's going to give us our bond interest expense. And there's a good formula in your books that you should keep handy when you're working this kind of problem, all right? And you're going to go about it now for the next payment on December 31st, you're going to duplicate what you did on June 30th. The numbers are going to be the same for the second payment and for all remaining payments, all right? Because eventually taking this discount on bonds payable with each payment is going to reduce this account called discount on bonds payable down to zero by the time you go and pay out the note on maturity. Okay. I may skip over this one because it's calculation similar to what we did in the other problem. So the only difference is it's selling at a premium instead of a discount, but you should be able to get the computation the same by now. I'm moving ahead to see if we're, let's see, I want to go to problem number 10. In each situation, show how bonds payable is reported in the long-term liability section of the balance sheet, okay? So in this problem, we're going to go ahead and we're going to select bonds payable, which is $10,000. And then premium on bonds payable, which is $240. And that's how you will complete this section of the balance sheet. The next one is different. It's a discount on bonds payable. So again, we will select bonds payable. Come on, that's going to be 30,000. And then discount on bonds payable. And that will be a minus 500. I don't know if it's going to let me do this or not. Yes, it does. Okay, good. All right, and that's how it's going to be. That's how it's going to look on the balance sheet. All right, bond retirement. Now, what happens, as I pointed out in the video that I did discussing the chapter, is companies can call back bonds if it's in the contract that they can do so, and a lot of them have that in the contract. There's a lot of different reasons a company would want to do that. But the bottom line is, what do you do if there is a call? Call option requires that they pay $408,000 for its outstanding bonds, even though the par value is $400,000. In other words, you get a little bump for being called in early, and they have a carrying value of $416,000. So we're going to record the entry to retire the bonds. Now, if you notice, looks like we're going to make a little money on this because the carrying value is $416,000. All right, but we're only paying $408,000. That's giving us an $8,000 gain on the books. So the first thing we're going to do is we're going to debit bonds payable, which wipes out that account because we called them back, and that's going to be $400,000. Then we got to get rid of the discount on bonds payable, which is $16,000. So, I'm sorry, premium. I didn't mean to say that. So we have to debit that account to bring that to zero. And then we're going to credit gain on retirement of bonds. And again, I pointed out to you how we were able to identify that this is a gain. Where is gain? There we go. $8,000. And then cash, which is what we're paying out, of $408,000. Number 12. Now we're going to start working on installment notes. Okay, on this problem, January 1st, $50,000 in cash is borrowed from a bank in return for a 6% installment note with 24 payments of $2,216 each. So we're paying it back in 2 years. So to record the issuing of the note, all right, that's easy. We're just going to do a debit to cash for $50,000 and they credit the notes payable because now we owe that money, so it's going to become a liability for $50,000. Next, we're going to prepare the journal entry to record the first interest payment. So how we're going to calculate that is, all right, so here you're going to have to use the chart that's in your book. And I believe that you have a hint in this that gives you the chart. So you got to set up the chart in order to be able to track all the different payments on the note. Column A is the beginning balance, which is $50,000. Column B, which is the interest expense, which is 6% times 1 divided by 12, or 1/12. That comes to $250. Then we're going to have to debit notes payable for the difference between the payment, which we know is $22.16, and the interest, which is $250, and that comes to $19.66. And that's going to give us what we need for a journal entry. So our first debit is going to be to interest expense. And I told you what that was. That was $250. Next, you're going to have to debit notes payable, the principal payment, which is $1,966. And then finally, we're going to credit cash for the amount of the payment, which is $22.16. Then all those columns should balance with each other. Again, I believe you have a hint in here that you can use. It shows up in the instructor side, so I imagine it will be on your side as well. But anyway, go to the chart that's in your chapter and set it up on a piece of paper so you can make your calculations to be able to calculate what the interest will be, and so that you can calculate the difference between the interest after you get that number and what the payment is, because the payment's being stated in here for you. Okay, next. Recording bond issuance and interest. All right, so Boston Enterprises issues bonds that have $3.4 million par value, mature in 20 years, pay 9% interest semi-annually on June 30th and December 31st. The bonds are sold at par. How much interest will the issuer pay in cash to the bondholders every 6 months? Well, that's fairly easy. That's going to be, if it's, 9% interest? So they're going to get 4.5% interest twice a year on that $3.4 million. Next, prepare the journal entries showing the issuance. We've done that already, so I'm not going to go back and repeat that. And also the first and second interest payments should be easy as well. We've already done those as well. Then finally, you're going to record the issuing of the bonds at 98 and 102. 98 is selling at a discount 102 is going at a premium. So you know what you have to do there. Again, we went over how to set that up in earlier problems. This is another call option, and we've already gone over that, so I'm going to skip over this one as well. This is what I was talking about when we're talking about a note being amortized. Now, what's not showing up here, and let me pull this up in my book, so I can tell you, give you some hints here. Nope, I went too far. Bear with me a minute. Okay, so let's look at this, and you might want to make some notes while I'm giving you this. Beginning balance is easy. Your beginning balance is going to be $100,000. You're going to debit interest expense. What's the interest expense? Well, it's 7% times 1/12. Okay, we are making monthly payments. Oh no, I'm sorry. Wait a minute. Note requires 4 equal payments. So 1 payment each year. So you're going to take 7% of 100,000. That's going to be your debit to interest expense. Then you're going to debit notes payable. That's going to be the difference between the payment of $29,523 and the interest expense you did in B. Okay. So in other words, it's D minus B equals C. Let me repeat that. D minus B equals C. And then you subtract C from A to come up with E. I'll repeat that again. You're going to take A, subtract out C, and that's going to equal E. All right. And then column A becomes, in 2022, becomes column E in 2021. They should equal each other. That's how you want to work this problem. And you'll keep going until it becomes 0 in 2024. January 1st, $30,000 in cash is borrowed from a bank for a 12% note with 36 monthly payments of $9.96 each. So let's see how we're going to set this up. Yeah, you're going to have to prepare an amortization table, just like what we went over in the last problem. So if you're unsure, go back to problem 15 and listen to what I said on how to handle each column. All right, it's pretty clear. It's also in your book. You can go to the chart that's in your book and it tells you the exact same thing. The next are balance sheet entries. This is pretty straightforward, so I'm not going to go through this in detail. If you need an example, you have an example in your book. But I mean, you should by now understand what current liabilities are. Those are going to be paid in less than a year, and what long-term are. Those are going to be due in more than a year. And we have another problem where you're paying back a note. Just set it up the same way as the other ones. Okay, you have the information here. You just go through and set up the amortization table accordingly. All right. As always, if you have any questions, oh, I see we have some participants that joined. Participants, do you have any questions before I end the session?
No, sir.
Okay, so if you don't have any questions, I'm going to go ahead and end at this point. As always, you can get a hold of me by email if anything comes up. One thing I sent out this week was that I was a little surprised by some of the answers that are going into the homework that are correct or not being recorded as such. And I've alerted the department head about it. I'm hoping he goes and just takes out those problems and gives everybody points for it. But if you do have that problem, let me know and I'll go back in and give you points that you lost for having the correct answer. Have a good week and Lori and Sharon, I don't think you were on, but I am not going to have my next session until next Monday because of Easter being Easter Sunday, and I suspect a lot of folks will want to be with their family. So have a good week and have a good Easter.
Thank you. You too.